I'm genuinely sorry I'm not able to be with you in person in Sydney, but it has saved over 7 tonnes of carbon, and it is climate change that we are focusing on today and the actions we can take to try to mitigate climate change. By way of background, the Environment Agency Pension Fund is a $5 billion Australian dollar fund with 40,000 members and over 95% participation from current employees, most of whose work involves managing the day-to-day impacts of businesses on the natural environment and the risk of river and coastal flooding across all of England. So it's not surprising, but the most frequent challenge to our investment strategy we get from our members is, what is my fund doing about climate change? Fortunately, we have a good answer, although maybe not as radical an answer as some members would like to hear. Unsurprisingly, some members say they would like us to divest from fossil fuels altogether, but that's not the right strategy for us. However, our approach does combine a commitment to decarbonisation, investment and engagement. So let me describe our approach to ESG issues. We seek to integrate environmental, social and governance issues into all our investment decision making and to be good stewards of the companies in which we invest. But we can only do this intelligently and effectively if there is consistent and comparable disclosures from those companies we invest in and by those managers we invest with. I'm often asked why we have adopted such a strong position on responsible investment. And to be crystal clear, we are responsible investors, but we are not ethical investors. But seeking strong long-term financial returns is at the centre of our approach to investment. But we believe, based on a considerable body of evidence, that doing it responsibly, and by that I mean thinking about all the risks that might impact a company's prospects, protects those returns and delivers better value over the long term. Thinking long term makes you more aware of issues relating to the planet's natural capital. That is, resources which companies, economies and society at large rely on, but to which markets have thus far failed to attribute their true value. This undervaluation can lead to exploitation and environmental degradation. So we focus as an environmental regulator on water and on carbon. Each year we analyse our equity portfolio to look at the environmental footprint of our investments. Water accounts for 38% and greenhouse gases for 30% of our footprint, by far the 2 most significant environmental impacts and by extension the most significant risks. Water is a prime example of undervaluation by the markets, and yet is an irreplaceable resource for all communities, whether for household use, irrigation or use by industry. And these water and carbon risks intersect and amplify each other. Indeed, we discuss that issue in our recent policy to address the impacts of climate change, and in your conference brochure you'll find details of how you can obtain a copy of that new policy. In overview, what the policy says is that we commit to ensuring that our fund's investment portfolio and processes are compatible with keeping the global average temperature increase to remain below 2 degrees centigrade, and have set corresponding goals to invest, decarbonise and engage. In regard to carbon, we aim by 2020 to invest 15% of the fund in low carbon, energy efficient and other climate mitigation opportunities. We also aim by 2020 to decarbonise our equity portfolio, reducing our exposure to future emissions by 90% for coal and by 50% for oil and gas. But essential to all of this is transparency and disclosure. And we're committed to stepping up our work on demanding high disclosure standards and increased transparency, not just by companies, but also by fund managers, asset owners, and other financial intermediaries. The Environment Agency Pension Fund has used carbon disclosure data to support its managers' engagement activities on greenhouse gas reporting, water, and forestry. And we are pleased to have directly contributed to engagement successes, most notably Kingspan on reporting carbon emissions and Tesco's in their participation in forest programmes. We want to deploy capital aware of risks and opportunities, such as those that arise from climate change and water quality and availability, but also actively encourage others to do so as well. However, the failure of companies to adequately report on those risks is a significant barrier to progress. I have so far highlighted 3 of the pillars of our approach to responsible investment at the Environment Agency Pension Fund. Those being 1, being open and transparent, 2, integrating ESG issues into our investment decisions, and 3, acting as a good steward of the companies and funds in which we invest through voting and engagement. The 4th pillar is about working collaboratively with others, including asset owners, fund managers, academia, policymakers, and others in the investment industry. My talk to you today is an example of such collaboration. I have briefly outlined some of the key features of our approach to responsible investment, and I would encourage you to look at our website for more information, and as I say, your conference brochure describes how you can do that. But we too are also keen to continue to learn and to benefit from the experiences of others. So we'll be delighted to hear more of what you are doing, sharing your policies, case studies and work in this area as we work together to influence climate change as an investment industry. Thank you.